started previously in the previous lectures about our variance analysis, or in our variance analysis topic, and we saw how to analyze, of course, first of all, to calculate the variable manufacturing overhead variances and interpret these variances. And as we said, that this 10,500 unfavorable variance could be divided onto a spending variance and an efficiency variance, of course. We saw how it is calculated and how it is interpreted. Now, only one point remains in this chapter: how to calculate the fixed manufacturing overhead costs, variances, of course. Therefore, we are going also to take this variance and analyze this variance onto the different classifications of the variances that we already took. Of course, we said that according to the variable manufacturing overhead, we have efficiency variances and spending variances. Correct? Now let us take the fixed manufacturing overhead code, which has a variance by the amount of 9,000 unfavorable variance. Do you think that this 9,000 unfavorable variance is a spending variance or is an efficiency variance, or both? So what do you think? What is an efficiency variance? We said according to the variable manufacturing overhead, what is the efficiency variance? The efficiency variance is the variance because of the difference between the standard quantity, of course, of the allocation base, and the actual quantity of the allocation base. Correct? And the spending variance is the variance because of the difference between the standard rate. There's no price in the variable manufacturing overhead and the fixed. We do not call it price because it is a rate, it is a ratio that was calculated in the beginning of the year. Therefore, it is the spending variance is the difference between the standard rate and the actual rate. So now let us take the 9,000 unfavorable variance and let us interpret this variance. Do you think that this change from $276,000 to $285,000, which is 9,000 higher than expected or than budgeted, is because of the higher machine hours than expected? Of course, as we all know, as we all took, that this amount, the flexible budget amount, 276,000, is according to the static budget, is according to what was budgeted. Therefore, this was according to the 4,000 hours of machines. Correct? The flexible budget amount of 276,000 was considered according to the 4,000 machine hours. Correct? Because this is the same number as the number within the static budget. But according to our actual results, the machine hours was 4,500. So do you think the change in the machine hours, or the increase in the number of machine hours, has increased our costs, or fixed costs, or fixed manufacturing overhead costs? What do you think? Yes?
Does it affect by the output that is produced? So it's fixed.
Excellent. Therefore, according to our definition of fixed manufacturing overhead costs, or fixed costs, as we took in cost accounting 1, that fixed expenses or fixed costs does not change in total as the number of units, of course, produced, or as the volume level changes. Therefore, this amount would have been fixed if we used 4,500 machine hours or we used 3,500 machine hours. This is the definition of a fixed cost. Therefore, according to this definition, we would say most definitely that we will never have an efficiency variance. Therefore, in our analysis of fixed manufacturing overhead costs, because of the definition or because of the term fixed costs, we said that these costs will not change as the level of production or the volume of production or the number of units of the cost driver or the number of units of the allocation base changes. Therefore, it will be fixed. It will not be changed as there is a change in the number of units of the allocation base. Therefore, according to this definition, according to this concept, this means that if we really had or actually had a difference between the standard quantity and the actual quantity, it would not affect the cost or the total cost, which is the fixed manufacturing overhead costs. Therefore, according to this analysis, according to the definition of fixed costs, we will never have an efficiency variance for the fixed manufacturing overhead costs. Therefore, this leaves us with only one possibility. Therefore, the whole amount of 9,000 unfavorable fixed manufacturing overhead flexible budget variance is because of only one reason, which is the spending variance. Therefore, the 9,000 unfavorable variance, or the $9,000 that was spent more on fixed manufacturing overhead costs, was because of us spending more on these items than expected or than budgeted. Therefore, the flexible budget variance for fixed manufacturing overhead costs is the spending variance. Why? Because we never have an efficiency variance according to our definition to the fixed manufacturing overhead costs. Any questions? Do you have any questions? Therefore, what might be the causes of spending variance within the fixed manufacturing overhead? Who can first of all give us some examples of the fixed manufacturing overhead costs here?
Could be rent, excellent. Depreciation could be depreciation, excellent. What else? But here depreciation, you are correct. This is one of the examples, but it is not one of the causes.
Unless we had a change in the depreciation method that we are using, but this is something to consider if there is a change, maybe the depreciation method. Of course, administrative salaries. We have supervision costs. The salaries for the security and so on. Therefore, as we can see here, that we have a lot of items within the fixed manufacturing overhead cost. Therefore, if any cost or any amount was paid in excess of what was expected or what was budgeted, this would be a spending variance, or this would cause a spending variance. For instance, we expected to pay rent by the amount of $10,000 for our, of course, we are talking about manufacturing costs, therefore this is the rent would be for the factory itself. Therefore, the rent was expected to be $10,000, we paid $15,000. Therefore, we have a $5,000 spending variance, for instance. We expected to pay salaries for the supervision or the supervisors by the amount of $100,000, we paid $110,000. This is a spending or unfavorable spending variance. And of course, we could have a favorable variance if the expected fixed cost, or sorry, the actual fixed cost was less than the expected fixed cost. Any questions? Therefore, as you can see here, the fixed manufacturing overhead variance analysis is quite simple, because we do not have efficiency variances, and only the flexible budget variance is because of one cause only, which is the spending variance. Therefore, we can assume always that the amount within the flexible budget variance for the fixed manufacturing overhead is because of the spending variance. Any questions? Now let us consider another type of variances. According to our standard costing, and as we discussed in Cost Accounting 1 in normal costing, we said that we could not wait until the end of the period in order to allocate our costs. We need to allocate our costs within the process itself, within the year itself, because in order to have corrective actions, in order to know or in order to control our costs, we need to have this feedback, this continuous feedback. And we will not have this continuous feedback, we will not be able to make corrective actions unless we allocate the cost of course, the manufacturing overhead, whether the variable or the fixed, within the year itself. Therefore, it should be a continuous, let us say, a continuous process within the year. Therefore, in order to have this, or in order to attain this goal, we need to use the budgeted rate. Of course, this discussion, this topic that I am talking about, we discussed in Cost Accounting 1. Therefore, we need to use the budgeted cost in order to have an ongoing process of, let us say, knowing the cost within the year or within the period itself. Therefore, we could not wait until the end of the period in order to know our actual cost and to know our actual rate. Therefore, if I could not wait until the end of the period, I need to have a budgeted rate. This is why, according to our normal costing that we took in Cost Accounting 1, we calculate the standard rate, or we calculate the budgeted rate, and we are going to allocate the cost according to the budgeted rate, but according also to the actual number of units of the allocation rate. But here in the standard costing, we are going to use the standard rate, correct? According to our definition of standard costing, we said that standard costing allocates manufacturing overhead costs according to the standard rate multiplied by the standard quantity, correct? Therefore, now I need to ask you this question. What would be the amount allocated in April for this company or web company? Of course, according to the fixed manufacturing overhead, I'm talking about the fixed cost. What would be the amount allocated for this month? According to what we took earlier, we took the 4 steps according to what we took earlier, we took 4 steps in order to determine the standard rate, correct? Didn't we take this in the first thing in this chapter? We said that before beginning with anything, we need first of all to calculate the standard rate. And according to our number or budgeted number of machine hours and the budgeted fixed overhead cost, we have calculated that we would allocate $57.5 per what? Per machine hour, per standard machine hour. Why? Because the allocation rate that was determined or that was used is machine hours, as you can see here. Therefore, we would allocate according to what? According to this $57.5, which is problematic for us. Why? Because if I am using the 67.5, and I said this earlier, that we need to be careful in understanding this number. Because anyone who sees this number would think that if I incur or if I use 1 machine hour, I would incur $57.5. If I'm not using this machine hour, I will not incur the $57.5. Therefore, we might think of this number as a variable cost, not as a fixed cost. This is the problem. And when we allocate the cost, we do exactly as if we are treating the fixed as if they are variable. This is the problem. Therefore, we are going to allocate $57.5 for each standard machine hour, which would be problematic. Why? Because we all know, according to what we just said, that the fixed cost will not change according to the change in the number of units of the allocation base. Therefore, the assumption that each machine hour would cost $57.5 is incorrect, because this cost will be incurred whether we use this machine hour or not use this machine hour.
We should use this number for allocation, not for analysis.
Excellent, excellent. And if we use this in our analysis, we need to consider that this is a fixed cost, not a variable cost. Because if we are carried away with our interpretation and we said, or we, let us say, try to analyze this number as if each machine hour would cost 57.5, it would be problematic in our interpretations. We would not get to the correct interpretations. Yes, so the problem here is that when we allocate the costs, we are going to allocate according to the $57.5. Therefore, we are going to allocate, or we are going to treat the fixed costs as if they are variable. Therefore, this is the problem that would arise in allocating our fixed expenses. So now I'm going to ask you once more, how much is the amount that would be allocated for the fixed manufacturing overhead costs? Of course, as we just saw, that this is 276,000. This is the budgeted amount. This is the budgeted amount that will not change according to our understanding, will not change whether we use 4,000 machine hours, 5,000 machine hours, 3,000 machine hours. But the problem is when we use the per unit basis, the per unit fixed cost, we are going to say that it will make a difference. Therefore, now we need to consider the difference between what was budgeted that would not change and what was allocated. Therefore, we would have another variance, which is called the production volume variance. Therefore, what do you think is the amount that should be allocated? What do you think? According to our analysis, according to our calculation before the start of the year or the start of the fiscal year, we calculated that the fixed manufacturing overhead cost per unit is $57.5. Therefore, per what? Per standard machine hour. Therefore, according to our standard, because as we took in standard costing, the definition of standard costing, that we are going to allocate according to what? According to a budgeted rate and according to what? To budgeted or standard quantity. Therefore, I'm going to multiply the standard quantity with the standard rate. Therefore, if I'm going to allocate in this year or in this month of April, we are going to allocate according to the 4,000 machine hours. That is the standard amount of machine hours to produce what? To produce the actual number of units of 10,000 units. Therefore, the quantity or the standard machine quantity is the 4,000 machine hours. Multiplied by the standard rate, of course, according to our calculation before the start or prior to the start of this year, we calculated that the fixed manufacturing overhead cost per unit, as we saw from our steps, is $57.5. Therefore, the standard rate multiplied by the standard quantity, 57.5 multiplied by 4,000 is $230,000.
To allocate per machine hour or per job?
Per machine hour, because the allocation basis is the machine hour, it is not the units.
But we can use it per job.
Of course we can use it. If we change the 57.5 from per hour to per unit, we could do that here. No problem. Therefore, as we can see here, that we treated the fixed costs as if they were variable. What do you mean by this calculation? I say, according to this calculation, that each unit of the 4,000 hours has used up or has incurred $57.5 per this hour. Is this correct? It is not correct. Why? Because as we can see here, the cost, according to our allocation, would be only $230,000 because the machine hours here was less than expected.
Yes.
How was it less than expected?
5,000.
Because according to our static budget, we calculated or expected to have 12,000 units, not 10,000 units. Therefore, we have a variance here by the amount of what? Of 2,000 units. Therefore, I'm saying here that because I did not produce the 2,000 units, the cost would be less. Is this correct? It is not correct according to our definition of the fixed manufacturing overhead. Therefore, we would have a variance. We need to treat this variance. We need to calculate this variance according to what? According to the difference between the 230,000 and the 276,000, which is the actual number that should have been taken into consideration. Of course, according to our standard costing, this is the amount that we are going to allocate. This is the amount that we are going to consider. But the actual amount that should be, or that should have been considered, is the 276, not the 230. Any questions? Therefore, now we have another type of variance. Of course, as we said, the difference between the 276,000, which is the static budget amount, and the 285, which is the actual amount, is the spending variance and only the spending variance. As you can see here, we do not have any second columns. As we can remember in the variable manufacturing overhead, we had a second column in order to differentiate or in order to divide the 9,000 unfavorable variance onto spending and efficiency. Here we do not have an efficiency, therefore we do not need a second column. Therefore, the difference between the flexible budget or the difference between the static budget, because the flexible budget amount and the static budget amount is the same, and the actual is the spending variance. On the other hand, treating the fixed manufacturing overhead as variable expenses caused us a problem, caused us to allocate less costs than actual, or than expected, of course, but less than expected costs according to our flexible budget. Therefore, we need to consider this variance as something called a production volume variance. If you could remember from Cost Accounting 1, we started with this analysis. In our variable costing chapter, when we considered variable costing, we introduced this amount, or we introduced this variance, and we said that we are going to take this variance in details in Cost Accounting 2, and here it is. The production volume variance is the difference between the allocated fixed manufacturing overhead and the flexible or the static budget amount of the fixed manufacturing overhead. Therefore, what is the cause or the main reason of this production volume variance? Is the treatment of fixed manufacturing overhead costs as variable costs. This is the problem. Therefore, we need to consider the $46,000 unfavorable production volume variance. Of course, as we can see here, we allocated only 230, while as we should have allocated 276. From cost accounting one, is this under allocation or over allocation? This is an under allocation. Therefore, we need to increase our allocated cost in order to meet the $276,000. Any questions?
But don't we have to do it or write it off?
Of course. We are going to take this when we take the, or when we consider the journal entries for these amounts. Any questions? Therefore, now let us go to the journalizing of these variances. Of course, the fixed manufacturing overhead is a manufacturing overhead expense, correct? Which would be considered as the variable manufacturing overhead. Therefore, as we are going to show that the variable entries is the same as the fixed manufacturing overhead entries. Therefore, according to our normal costing, first of all, we need to consider the actual manufacturing overhead cost. In this case, we are going to consider only the fixed. Therefore, fixed manufacturing overhead control would be debited by the actual costs. And of course, according to our various accounts, it could be accumulated depreciation, could be salaries payable, wages payable, could be accounts payable, and so on. Of course, I'm talking here about normal costing. I'm not going to take these numbers because this is according to standard costing, not more normal costing. And then, after taking into consideration the actual costs, we need to allocate the fixed manufacturing overhead according to what? According to the budgeted rate, but using the actual quantity. Why? Because we are using the normal costing. Therefore, we would debit the work in process, and we are going to realize or recognize a contra account for the fixed manufacturing overhead control, which is the fixed manufacturing overhead control allocated by the amount that is allocated using the budgeted rate. Of course, as we took in cost accounting 1, most definitely we would have differences between these two, between the fixed manufacturing overhead allocated and the fixed manufacturing overhead control. Why? Because this was allocated according to a budgeted rate, and this was according to an actual rate. Therefore, we would have a difference. The difference would be an under allocation or an over allocation. Therefore, at the end of the period, we need to close this account and recognize any variances between the two. We would recognize any under allocations or over allocations. Therefore, the fixed manufacturing overhead allocated would be debited in order to close this account, and the fixed manufacturing overhead control would be credited. The difference between the two is either an under allocation of fixed manufacturing overhead, of course, or it is an under allocation. Over allocation. Of fixed manufacturing overhead. This or these are the entries that would have been recognized in the normal costing system. Now, what if we are using the standard costing system? The same entries. The only thing that would differ now, that this under allocation and over allocation is either a spending variance or a production volume variance. Therefore, in a standard costing, we are going first of all to recognize the actual cost by this or by using this entry. Therefore, we are going to recognize the $285,000. Then we are going to allocate using the standard quantity and using the standard rate. In the normal costing, we would use the standard rate, but the actual quantity. Here, in the standard costing, we are going to use the standard quantity instead of the actual quantity. Therefore, according to our calculations, we would use the standard rate by the amount of 57.5 and the actual, and the standard machine hours or standard quantity by the amount of 4,000. Therefore, we will allocate $230,000. Of course, as we can see here, we have a difference between 230 and 285. What is this difference? This difference is a spending variance and a production volume variance. Therefore, we are going to close the fixed manufacturing overhead allocated amount, and we are going to close the fixed manufacturing overhead control amount. Of course, the allocated by the amount of 230 and the control by the amount of 285. And the differences are these variances. Both are unfavorable, therefore both would be debited. Therefore, we have a spending fixed manufacturing overhead variance by the amount of 9,000. And then we would have a production volume variance by the amount of $46,000. Any questions? Now, we need to consider what we are going to do with these variances. Of course, we took in chapter number 7 that we would have a rate variance or a price variance, or we would have an efficiency variance. In chapter number 8, we saw that we could have a spending variance or an efficiency variance or a production volume variance. So, now the accountants have these accounts, have these variances. Of course, as we can see here, we recognized from an accounting perspective these variances. Now the question here, what shall we do with these variances? So what do you think? Well, of course, we took, it is the same thing that we did in cost accounting 1 for the under allocation and the over allocation. What did we do with the under allocated amounts and the over allocated amounts? Excellent. We had the choice either to prorate these variances onto the cost of goods sold, onto the finished goods inventory, and onto the work in process inventory. Or we could write off the whole amount onto the cost of goods sold. So what do you think we should do? Of course, we are now talking, our discussion will be on the variances except for the production volume variance. because the production volume variance is or has a more, let us say, details in or more discussion than the other variances. Therefore, what do you think we should do? Shall we prorate it to the different accounts, or shall we write it off to the cost of goods sold? What is better for, from the perspective of the organization?
Based on the materiality of the variance itself.
Excellent.
If it's material, we will write it off to the cost of goods sold.
Excellent.
But if it's material, we will depend on the variance, maybe for the 4 account or the 3 account.
Excellent, excellent. Therefore, the first thing that we need to consider is the materiality of this variance. Is it, or is the percentage of this variance a high one? Therefore, is this variance is more than the margin of error that we talked about in chapter number 7, or is it within the range, within the margin of error? Therefore, if it is immaterial, we would have write it off to the cost of goods sold without any problems. But if it is material, we need to consider, is it, or is these variances where, because of the inefficiencies of the management, or were these variances because of some factors that are out of the control of the management? Therefore, now, if the variances are immaterial, we would write it off to the cost of goods sold. Because as we all took in accounting principles 1 and 2, that if any amount is immaterial, an accountant would have the choice to not use the generally accepted accounting principles, because we all know that these variances would affect the work in process, would affect the finished goods, and would affect the cost of goods sold. Therefore, the most accurate way to get rid of these variances is the proration method, as we took in cost accounting 1. But if this amount is immaterial, therefore I could get out of this accuracy, I could get out of this accepted principles in order to write it off all into the cost of goods sold. But what if it is material? So what do you think if it is material? What is the thing that we need to do? Is it proration or writing off to the cost of goods sold? According to another criterion, which is, as I said just now, that we need to consider if this variance was within the control of the management or outside of the control of the management. Therefore, if it is because of some inefficiencies in the management itself, we do not need to carry this inefficiency from one period to another. Therefore, we would write it off to the cost of goods sold. But if these are, or if these variances are because of some factors that are out of the control of the management, therefore, this amount or these variances should be prorated to the work in process, to the finished goods, and to the cost of goods sold accounts. This is the method that should be used for the variances, whether they are rate or price, whether they are spending variances, whether they are efficiency variances. We will consider this line of thinking when we consider what to do with these variances. Now, the production volume variance. Of course, also the production volume variance could be written off to the cost of goods sold, or could be prorated to the cost of goods sold, finished goods, and the work in process. What do you think is a best or is a better way to get rid of this production volume variance? But before answering, what is the main cause of the production volume variance? What do you think is the main cause of the production volume variance? We said it, we just said it. What is the main point, or what is the main cause of having a production volume variance, which is unfavorable, which means that the allocated is less than the expected, or favorable, which means that the allocated is more than the expected. So what is the main cause here of the production volume variance? Excellent. Excellent. From its name, production volume variance. Therefore, the cause of the production volume variance is the difference between the actual output and the expected output. Because if we use or if we produce 12,000 units, we would not have a production volume variance. Because multiply 12,000 by 0.4 multiplied by 57.5, it would give us the 276,000. Therefore, we would not have any production volume variance. Therefore, the problem here was because of producing less units than expected. We produced 10,000, while as we expected to produce 12,000 units. Therefore, this is the main cause of the production volume variance. Correct? So, what do you think we need to do with this variance? Shall we write it off to the cost of goods sold or prorate it to the different accounts? What do you think? Write it off to the cost of goods sold. Why do we need to write it off to the cost of goods sold? Or why not prorate it to the different accounts?
Because we have the cost of all the production process.
So,
for the different.
Therefore, the production volume variance could be prorated or could be written off. Some say that it would be a better way to write it off directly to the cost of goods sold. What is this, or why do they take this decision, or why do they take this method? They say because that this amount, $46,000, which is unfavorable, was because of producing less number of units, correct? Therefore, if we produce the 10,000, the 10,000 would consider only the 57.5 per unit. Therefore, we would incur, or let us say the part of cost that is related to the 10,000 units is the 230,000, not the 276,000. Therefore, the $46,000 of unfavorable production volume variance is because of the 2,000 units that were not produced, correct? Therefore, the analysis here would say why to prorate this amount, why to carry this amount onto the 10,000 units, and this cost was not related to the 10,000 units, correct? Our capacity here, what do you mean by fixed expenses? This is our capacity, correct? Therefore, I am paying $276,000 in order to have a capacity to produce 12,000 units, correct? Which is what we took in cost accounting 1 according to our capacity analysis. Therefore, if I produce only 10,000, why shall I carry the amount of 46,000 onto the 10,000 units? Because we did not use the whole capacity, therefore the 10,000 units was not to blame for this $46,000 of unfavorable production volume variance. Therefore, from this point of view, we should not prorate the amount of $46,000 onto the work in process, the cost of goods sold, and the finished goods. Why? Because the $46,000 was because of unused capacity. It was because of the 2,000 units that was not produced. Therefore, the line of thinking here says that we should not blame the 10,000 units that was actually produced by this unused capacity. This is one line of thinking. Of course, we are out of time now. We are going to continue this analysis.